What's up everybody, Jaspreet Singh here, and with the stock market entering bear market territory and a potential recession on the horizon, many people are wondering now, what do you do with their money? How do you invest your money in a bear market? Now, the first thing that I want to say is that generally, recessions, market crashes, and these types of volatile markets create more millionaires than any other time, because when you have these types of downward markets, you see good assets, good investments go on sale because people get scared, they panic, and then they sell. And then when they sell, this pushes the price of assets across the board, whether they're good or bad, down. And this is where you want to look for the good opportunity, because there will be toxic assets that cause the price of good assets to go down. So you want to be able to determine what are the good assets, how can you find them, how can you buy them on a discount, and how can you use these assets as a way for you to become wealthy. Now, of course, you need cash in order to do this, because you need to be able to take advantage of the opportunity when it comes your way. But what I want to do in this particular video is go over different types of investments, different types of stocks, different ETFs that you can consider investing your money in when you're in this type of bear market. I'm going to go over a list of, let me just read my notes, 6 different types of stocks that you can invest your money in when you're in this type of bear market. So let me start with number 1, which is investing your money in general America. Because what we've seen throughout time over the last 100 plus years is that the American economy has been resilient and it's not going away. I know there's a lot of negativity out there. Oh, the world is ending, that inflation is going to destroy the economy, is going to destroy the dollar. At the end of the day, booms and busts are a part of the economy. It's a part of this economic system that we're in. Hate it or love it, it is what it is. And wealthy people, they just know how to use it. That's what you need to understand. Don't hate the game, don't hate the system. Learn how to use the system to your advantage. So in this system, we have booms and busts. And what you want to be able to do is take advantage of the bust, because now you can go and come in and buy assets for pennies on the dollar. And so when I talk about investing in general America, one of the simplest ways to do that would be by investing your money into an ETF, which is an exchange traded fund, which gives you exposure to something like the S&P 500, which is a group of the biggest 500 companies in America. So if you take the 500 biggest companies on the stock market and you basket them up into one ticker symbol, and you invest in that ticker symbol, you're essentially investing into all 500 of these companies, the biggest 500 companies on the stock market. There's a couple big ETFs that allow you to do this. VOO is one, SPY is another one. I'm personally invested into VOO, I have to let you know that. But when you invest in either one of those, you're getting exposure into the biggest 500 companies in America. And so if you believe in the future of America, and America goes through a tough time, we go through a recession, we go through a slowing economy, we go through this bear market, guess what? The biggest companies are gonna get hurt, which means these stocks go on sale, the prices go down. And if you invest in these ETFs, well, now you have the ability to own a piece of that. And then as it starts to go back up, because if you believe in the future of America, it will go back up. Well, now you got to buy them on sale, and your cash, whatever you used to buy it, was able to buy you more shares of these companies. The thing that I want to mention now is, if you are going to be investing in individual companies, you have to understand that, one, that means more risk, and that also means more research on your end. Because if you invested in one company, whatever you want to say, let's say you invest in Amazon because you believe in the future of Amazon. Well, if you're not willing to put in the work, then you're taking on a whole lot more risk. Because if you keep investing all your money into Amazon and they go bankrupt, which I know seems very unlikely, but if they go bankrupt, all your investment goes to zero. Versus if you invest your money into an ETF, now you have a lot less risk, because now you're investing your money into a group of 500 different companies. If one of the companies in your ETF goes bankrupt, well, then your computer will kick that company out and put another company in. So it's much less risky. And so if you want to invest in individual companies, that's fine. I mean, you can make much bigger returns that way, but you have to be willing to put in that work to do that research. If you don't want to put in that work to do that research, and you still want to invest in individual companies, then the next best thing would be for you to get a stock advisor, for you to hire an expert who's actually giving your stock picks, because somebody has to be doing that research. And if that's something that you're interested in and you're looking for someone to help you with that, well, then an easy way for you to do that is to check out our sponsor, Motley Fool. Because if you have $1,000 and you're looking for a way to invest in individual companies, they have something called the Motley Fool Stock Advisor, where they have experts who will email you stock picks every single month. The way it works is every month, their analysts will email you 2 stock picks that you can invest your money in. And their goal is for you to invest your money in these and see a big return on your money. And you're probably thinking, well, why would I want to trust these advisors or these experts? Well, at the time of me recording this video, their stock picks have returned an average of more than 300%. Now, does this mean that you're guaranteed to make money? No, of course not. Investing has risks, but you have to understand the philosophy when it comes to investing, because their philosophy isn't for you to just buy a couple stocks and hold on to it for 6 months. Their philosophy is for you to go out and buy a portfolio of 25 different stocks and hold on to them for at least 5 years. So it's a long-term investment game. So if you want to learn more about the Motley Fool Stock Advisor and see how you can become a member in the program and join the investment community, I'll put the link to how you can do it down in the description below. Now, this brings me to number 2, which is investing in tech. Now, the tech sector is going to be hit very hard over the next 6 months and the next 12 months because of the changing economy. We have interest rates going up, which hurts the speculative companies, the tech companies, the growth companies the hardest. So you can expect the tech sector to go on sale because you're gonna see some of these companies probably go away. Now, like I mentioned in the beginning of this video, when you have these types of environments, toxic assets, bad assets will cause the price of good assets to go down. This is where you wanna be able to look for the good assets because the tech industry is not going away. Technology is still gonna be around. However, it's going to go through a down phase as we raise interest rates. Now, again, if you're looking for a couple ways to invest in that, one option would be something like QQQ, which is a passive ETF that gives you exposure to the NASDAQ, which is primarily tech companies. And the second option would be to invest in more of an innovation-based fund, something like ARKK. Now, ARKK has been hit extremely hard because they're investing primarily in the growth and innovation. I do have some of my own money in ARKK. However, again, it's what is your time horizon? What is it that you want to invest in? Do you believe that innovation and technology will continue to be around in 10 years and 20 years? And is this an opportunity for you to find some of these assets on sale if you're willing to hold on to the technology companies for the long term? Number 3, would be investing your money in consumer staples. This is something that people need. So consumer staples become a very attractive investment when you are in a recession because consumer staples are things that people need in order to survive, like food, certain products and necessities that people have to spend their money on. So these are not discretionary items, not things that people want, like a nice handbag or a nice car. These are things that people need in order to fund and live the day-to-day life. And so when you invest in consumer staple companies, you're investing in the companies that produce the products that people will need, whether in a recession or a good economy. And if you're looking for a couple ETFs, again, I'm not telling you what to invest in any of these, just a couple examples. A couple examples of popular consumer staple ETFs are XLP or VDC. Number 4, the 4th type of investment that you can make would be to invest your money into dividend paying companies. And the reason why I recommend this or why it can be a good investment is because when you invest in dividend paying companies, you're getting cash flow. Now, the advantage of buying dividend paying companies in a downward market is you can buy more shares of a dividend company, and then as things recover, and if you invest in a strong company and the stock price starts to go up, well, now hopefully your dividends will also rise. So you can get a bigger cash flow because you can buy the asset at a lower price. And then as the stock price grows, your investment grows in value, but your cash flow also grows. So you're able to buy more cash flow when it's on sale. It's almost like buying a rental property because rental properties are a way to generate cash flow. If you could buy a property that generates $1,000 worth of cash flow at $200,000, not bad. But if you can buy the same property for $100,000, it's even better. So it's just the ability to buy some of these assets at a lower price. Now, of course, is there risk? Yes, because companies can cut their dividends, they can get rid of their dividends, they can go under, but this is where you want to do the research, or you can also consider investing in dividend paying ETFs. A couple of the big ones here are SCHD, that is the Charles Schwab dividend ETF, and then you have the Vanguard one, which is VYM. The fifth one would be now to invest your money into emerging markets. Now, this one is more of a worst case scenario type of situation where now you are investing in not just different countries, but also different currencies. So I do have some of my money invested into the ETFs I'm gonna mention, but the way that it works with these emerging market ETFs is now you can invest in countries like China and Brazil and Korea. And now what you're doing is you're investing in the companies that are growing in these different countries. I know it's kind of a word twister there, tongue twister, but now you're investing in the growing companies in these growing economies. And so you're investing in different currencies because they operate not with the dollar, and you're investing in different economies that don't rely on the American economy. So it's a way for you to get more of a different type of diversification, but it has a different type of risk now because you're not just investing in the United States, you're investing in countries that are smaller, that don't have the same military presence, that might not have the same stable government structure. So there's a different type of risk. But it kind of gives you more of the protectionary if you're worried about the long-term health of the economy. And it's always good to have some sort of, the worst case scenario type of protection. And the last type of investment ETF stocks that I want to mention before I get into the strategy side is investing now into something like a gold miner, because this economic slowdown that we're seeing right now is very unique compared to our previous ones, because right now the economic slowdown is primarily being caused from inflation. So we had high inflation, which caused the economy to slow down. And if inflation continues to be a concern, then people will want to get away from fiat currency, aka the dollar, and they'll want something more stable, something like gold. Now, I own physical gold. I prefer to own physical gold rather than gold miners, but if you want to focus on the stock market, then you can consider investing in stocks to give you exposure to gold miners or gold mining ETFs. An example of this would be something like GDX, where now you're investing in the miners that actually produce gold, because now, hypothetically, if inflation continues to be a concern in 6 months or 12 months and inflation isn't coming down to where the Fed would like, and inflation is worse than what people expect, well, then people will want to get away from the currency of the dollar, and they'll want to own things like gold. And if the price of gold goes up, well, then these gold miners make bigger profits. So, no, it's speculative there. I own physical gold. I don't invest in the miners. At the time of recording this video, I invest in physical gold because for me, it's another way of saving hard money, but it's another way for you to get that type of exposure. Now, when we talk about your actual strategy, the way that you make money now, if you really want to make real wealth, you have to be willing to invest your money for the long term. That means not just investing your money for 6 months or 3 months or 12 months. I know in the 2020 crash, that was a very unique crash where the market crashed in March, and by May, the market had recovered. The reason why it was able to recover so fast was because the Fed created so much inflation. The Fed printed trillions of dollars, they injected it into the market. So we saw this V-shaped recovery. I don't really see that happening right now because inflation is already such a big concern. And so it's going to be kind of more one of these where the market's going to go up and down in this downward trajectory until our economy can really stabilize, until things can get better. And we don't know when that's going to be, how long that's going to take. And so if you really want to build a long-term wealth, the people who make the most money over the long term, this is time tested, are the long-term investors. It's not the traders. Trading is attractive. It's hot. It looks cool. It's, got the real appeal in that sense. But at the end of the day, the long-term investors are the ones that make the most money time and time again over the long term. Maybe in the short periods, the traders can win, But over the long term, yes, the long-term investors who have the long-term mindset, who understand that they're in it for the long haul, not just for the next 6 months. Thank you for watching. If you enjoyed this video and you want to see the 9 money habits that keep so many people poor, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. Like, most people don't want to talk about money, right? And the reason why it's such a taboo topic is because many of us are insecure about our money.